Okay, guys, we're going to get started. This is Module 1, where we're going to cover the day the financial world turned upside down, what's fueling today's economy, how the super rich are creating empires, and what it means to you and those around you. So, with that, let's get rolling. August 15th, 1971 is the day I've targeted as the day the financial game turned upside down. And no one talks about it. No one talks about it in financial books, and almost no one talks about it when they're doing financial planning. But on that day, you can see here a picture of President Richard Nixon. He took us off of any semblance of a gold standard. Now, the United States had went off the gold standard in 1913, but the Bretton Woods Act of 1944 had partially tied the money supply to the gold standard. So it kept everything really stable and so forth. So we're going to talk about that right here. From January 1971 to June of last summer, June of 2018, the US money supply increased 32.3 times. So they increased the supply of money by 32.3 fold. And that was accompanied by an 84% drop in the purchasing power of the dollar. And to put it in perspective, you could essentially have bought back then for almost $16,000 what $100,000 would buy today. So an 84% drop in the purchasing power. I got curious and I thought, what did the stock market do in the same time period? And I took the Dow Jones Industrial Average and the S&P 500, divided them by 2, and they have increased by 31.8 times. So going back to this, the money supply has increased 32.3 times. The market has went up 31.8 times. The point there is that a lot of times when we look at the stock market, we think it's all about the companies and so forth, which it is to an extent, but you can see a direct correlation to the money supply and the stock market. Back in 1971, a new house was $25,200. A new car was $3,560. Tuition to Harvard was $2,600 a year. $2,600 a year. I don't even know if you could buy the books to go for a semester to Harvard right now for $2,600. But back then, you could go for $2,600 a year. A lot of people think of in terms of the money as having value. It only costs a little less than 4 cents to make a dollar bill. And it's not backed by anything because of this situation that happened on August 15, 1971. Now, we're going to get into it here, but the big picture that you need to understand is, why did the government feel it necessary to pull us off of any sort of gold standard? Well, at that point in time, towards the late 60s, early 70s, America wanted to grow. It wanted to expand. Well, there was only so much gold, so they couldn't expand the one thing that fuels growth, which is money. So they just decided to remove the gold standard altogether. Now, as we push forward, you're going to see this has had dramatic effect on our economy. And it's also had a lot of effect because people really aren't aware of this as a driver of what they're seeing on the news and in the market. So some of the positives of this change is it definitely expanded the economy. It enabled enormous growth in the last 40, it's been actually 48 years. Everything you look around, pretty much almost everything we see was driven by this one simple change because it created so much capital to build buildings, to advance technology, etc. It was like a jet engine on the economy that has exploded cities, neighborhoods, etc. And also those that saw the change and adapted to it actually became super rich. The negative side is that the divide between rich and poor is escalating. It really turned the money supply into monopoly money. It's based on a promise, not on a tangible asset. The government, like on everything, didn't really tell the government or tell the general public how to use, and purchasing power, as we discussed, dropped 84%. Now, the average population is working harder for less. A big thing is number two, traditional advice from the financial industry is not built for a debt-based economy, but it's still, even at some of the higher levels, being sold as actual advice. More people are on government assistance just to survive. And the government is the worst of all when it comes to abusing this debt-based economy. As we all know, we see that all the time of how much the federal government's spending above what they're taking in. Now it's down to, it used to be tax and spend, now it's spend and tax. Bottom line is they know it is backed by nothing. It's a virtual currency. Now, I'm not saying all this to scare you. I'm saying there's two sides to this. There's a huge opportunity that never existed before. And then for the average person, it is getting harder and harder just to maintain. What about the dollar supply itself? Well, this was as of April 8th, 2019, per usdebtclock.org. They had added to that point $587 billion into the money supply. It's almost $6 billion every day, 7 days a week. Now, the key point is 97% of all the new dollars are added through lending, which we'll talk about here in a moment. But what I want you to understand here is this is why the purchasing power continues to drop, because they keep adding more and more and more. This debt market used to be almost non-existent, got past 71, and then it just went right through the roof. But look at this. And again, the reason I'm showing all this is like the start of mastering money. You need to know what's going on, and then we'll talk about things to do to adapt. Now here, this was by BBC, showed the richest 1% of the world's population is worth more than the other 99% combined. Inflation calculator. The 48 years before 71, inflation was very stable and relatively low. What's interesting about that as well is that interest rates on actual savings, like in a bank, were relatively high. Where today, They're almost not, it's almost non-existent. So savings rates, interest rates were high, but inflation was super low. Now, in the last 48 years, it is way different. It's a totally different scenario, as you can see. Let's talk about some ways that it affect like everyone's life. Well, one way is college. You know, we're hearing all about the student loan debt and so forth. Well, just in right after 71 and then by 75, college costs started to go up faster than inflation. You know, prior to the 70s, college tuition rates only increased by 2 to 3% a year, which was on par with the rest of the economy. Since the 70s, they've been going up 5 to 6% above inflation. In 2003, college costs went up 14% in 1 year. Now, since then, and you look at in 2008, tuition fees had increased 439% since 82, while income had only increased by 147%. Now, this affects like everyone. Like if you have employees, family members, etc. This is just one area where prices are going up and up. Why? Because it's fueled by debt. If there was no student loans, these prices would not be increasing like this. If we were still on the gold standard, yes, a lot of increases would not have happened. But my point is, we went off the gold standard, which created just almost like unlimited money to throw at the colleges. And now it's got a lot of students in huge debt. Check this out. Additional consequence, student borrowing has doubled from 1998. Like it's just spiraling. Here's auto loans. You know, I remember back growing up in the 70s and 80s, you really didn't hear about people having auto loans. People would go buy a car and be done with it. And you can tell, you know, look at this, the amount of loans. But here's the thing. If you were around in the 70s and 80s, you remember like a brand new car was like $10,000 to $15,000. Now, like a starter type car, brand new, is $30-something thousand. I mean, it's unbelievable. And why? Because it's debt fueled. Mind the gap. This is the government spending. You can see they just, you know, got to the 70s, got their monopoly money, and just, you can see the spending just went out of hand. They are the worst of the worst. And this is just what they admit to. This isn't the unfunded liabilities like Social Security and pensions and so forth. Look at this. They have increased the debt 55.8 times. And this is the actual federal deficit, 22.2 trillion divided by what it was in 1971, 398 billion. So they understand that it's a monopoly money world that they created. And as you'll see as we go through the training here, you can adapt to this and take advantage of it. The problem with traditional planning is it is geared as if we are not in a debt-based economy, and it's as if we're still pre-1971, where you pay off all your debts. I'm not going to argue you shouldn't have, credit card debt on things you shouldn't, or that you consume, but for assets and things, debt is a real tool, as we'll look into. But the point is, it's super hard for you, as well as all of the people that surround you in your world, because of this debt fuel, and that traditional planning is based on more of a more secure model. But what it gave in security doesn't work today And at the same time, the opportunity todays, as you'll see as we go through the course, are way bigger than they ever were back then. So you can create actually more security today if you use a modern strategy than you ever could back then. Here again is the national deficit. You can see it. It's going along smooth until we hit 70s and then the 80s, and then it's just out of control. But again, this is the government. Here's the actual money supply. It used to be very low and stable. So this is a little bit of information on the Bretton Woods Conference 1944. It implemented the US dollar as the actual world reserve currency. The money from there became fractional money. About 10% of money was supported by gold and silver. The rest was paper. After 71, the fractional money ended, and then it became what they call fiat money. It's just based on a promise. All the money became paper, and it became a monopoly board. The damage done by the central banks is possible thanks to the fact that the money can be created out of nothing. This destroys the purchasing power through inflation or dilution, however you want to look at it. They're diluting it by adding more and more. Pre-1971, the money was linked to gold. After, it was linked to debt. Nowadays, it's how much debt you can access determines your wealth potential. From 1980 to 2019, debt or assets increased almost tenfold in the US. Debt increased 17-fold. So a little bit blurry picture, but this came off of the USDebtClock.org. This is why, if you're like me, I'm 51, if you've got kids that are growing up now, oh my gosh, they're upset because the income now, the median income, 33,000. In just 2000, it was 30,000. But look at the difference in housing prices. New home, 164,000 in 2000 versus 313 now. And look at that change in median income. The point of this is income didn't change much, but because the homes are fueled by loans, which creates money, more dollars into the economy via loans, they went up dramatically, even though the income did not change much. Here's the runaway debt in US beats the GDP growth. You can see where the gold ended, boom, all the way up. Now again, there's massive opportunity, which we're going to get into. But at the same time, if you're living as if we're pre-71, it's not a good time. I pulled this. I went to that Grant Cardone down in Miami. He had a business boot camp, 10X business boot camp, I believe it was in February. And this was, for business owners, and we were talking about, employees and so forth. And his point was their money is your money problem. 76% of people are living paycheck to paycheck. 64% have nothing in savings. 90% have no clue. A big expense, which is taxes. 94% fail the literacy quiz. 67% can't pass basic finance test. 10% of Americans collect 50% of all income, and 10% of Americans own 84% of the wealth. Why am I saying this? Well, a lot of times you are the biggest earner in your family. My clients typically, there's no one else in their family that's earning what they're earning or creating, if you will. Well, this is your family members. This is your employees. This is, Grant Cardone actually made a great point at the conference. He said, if you're on a bus and 76% of the people on there have a cold, you can get a cold. pretty quick, right? Get infected with the virus. And you might be just doing wonderful things and getting way ahead financially, but it's very easy when you're surrounded by so many people that are hurting. And a lot of them are hurting because, again, it's a credit fueled or debt fueled economy that's driving cars, houses, college education, and numerous other things way into the stratosphere as far as cost. So what does this mean to you and me? Playing small is not an option any longer. It used to be like in pre-71, you could do well for a little bit and just kind of throttle it all back because pretty much everybody had a pension. Life was very simple. There was very little rise in pricing. Everything was good. Nowadays, if you want to create an awesome lifestyle and keep that lifestyle, you better be looking at new ideas, which you're doing in this course. You're looking at new ideas that can take you to a whole nother level so that you can maintain and your family can maintain. Number two, the game isn't rigged. It's a different game entirely. What I mean by that is a lot of times you'll hear people saying, oh, the game's rigged, it's rigged. It's a debt-based game now. It's not an asset-based. It's not even the same game. Number three, today's opportunities, however, dwarf the previous generation's security level. And you're going to see that as we move into the other modules that we're going to cover, that you can create more in 5 to 10 years than they could have done in 40 to 50 years because of the technology, the strategies, and the access to virtual money. Number four, traditional advice, as I mentioned earlier, is obsolete. It's not built for a debt-driven society. It's not built for that. It's built for somebody in the 50s and 60s. That's when it was actually designed. And I'll give you an example of this. If you think of like a Warren Buffett, okay, one of the smartest investors of all time, his wealth has went up 99 times since he turned 51. He turned 51 in 1982, right in the middle of all this changeover to a debt-based society. So here's the point, though. Did he get wealthy because he was so smart picking stocks? And you could argue that to a small degree. The other point, though, is he's using other people's money. Other people's money, whether it's debt or whether it's shares of Berkshire Hathaway, he's using other people's money to give him the power to go buy the companies that make sense. So that's why his wealth took off. Goes back to number three. That opportunity at that level would have never existed if we were still on the gold standard, not at the same level. And finally, number five, America's divide between rich and poor will soon resemble third world countries. As long as we're a debt-based society, which we could be from here on out, you're going to have those that are using it to their advantage. And we're going to go through exactly how to do that in this course. And then you're going to have everyone else that doesn't have a clue how to use the system to their advantage, And so this module is basically just to set up what we're going to talk about next week, which is what I call the 3 pillars of wealth. And the 3 pillars of wealth will use this new debt-based system to create maximum wealth levels and comply to the way things are now, not the way they were before 1971. So that is it for week one. I wanted to give you kind of a history of what's going on, because as we go into the three pillars and then move on from there, it'll all make sense because it'll be based off of what we talked about today. So with that, I look forward to seeing you next week. And if you have any questions, simply send me an email and I'll get back to you as soon as I possibly can. And that's that. Have a great week.